Imagine just the sheer scale of it all. These huge complexes turning raw materials into, well, everything. And the global networks, ships, planes, trucks, moving trillions in goods, plus all the specialized services keeping businesses running.
It really is the foundation, isn't it? The literal building blocks, the machines, the transport, the business support, it's everywhere, underpinning modern life.
Exactly. From, the massive turbines making power to tiny components in your phone or just getting that package to your door, it's all the industrial sector.
Deeply embedded.
And while, consumer brands or flashy tech get the headlines, this sector, the industrial sector, often tracked using something like the XLI ETF, it's a core piece of the economic puzzle.
Absolutely. And its health, how it's evolving, that tells you a lot about where the economy's headed.
It feels like it's undergoing a pretty big transformation right now, too.
It really is. And understanding it means going beyond just picturing factories. You have to look at the mix of companies, how analysts value them, the big trends shaping things, and how it all links to the wider economy.
So that's our mission for this deep dive. We're pulling back the curtain, using a bunch of recent analysis and market data you've brought. We want to unpack what this sector really is, how analysts figure out company worth, the big forces driving its future beyond just cycles, and how it connects back to the economy and, maybe your investments.
Right. We've got insights from a study on valuation models across industries, recent reports on industrial real estate, which is crucial, an analysis of these longer-term secular growth trends that are creating real tailwinds, getting a clear, well-rounded view.
Okay, let's dive in. Starting with the basics. What exactly is the industrial sector according to, say, the standard definition?
Well, the standard is the Global Industry Classification Standard, GICS. Everyone uses it. And within GICS, industrials is pretty broad, but it breaks down nicely into three main groups.
Okay, walk us through those. What does each one actually do?
Sure. First up, you got capital goods. Think of this as the heady machinery, the big stuff.
Right.
These companies make and sell machinery, electrical equipment, stuff for construction and engineering, aerospace, defense products. Basically, the tools and systems other businesses use to operate or build things.
So excavators, jet engines, power grid components, that kind of thing.
Exactly that. Fundamental stuff for industry and big projects. Then the second group is commercial and professional services. This is less about physical things, more about specialized support for businesses.
Like what?
Oh, a whole range. HR services, security, commercial printing, environmental services, even things like consulting or outsourcing certain business processes.
Okay, so they help keep the wheels turning inside other companies.
Precisely. Essential operational support, often on a recurring basis too, which makes them a bit different. And the third main group is transportation. Pretty straightforward, companies moving goods and people.
Airlines, railroads, trucking.
Yep. Marine shipping, package couriers, logistics providers. All of that falls under transportation within industrials.
So it really is a diverse mix. Heavy manufacturing, specialized business services, and the entire logistics network. Definitely more than just smokestacks.
It is. And it's often called the backbone of the economy because it's so essential, which might suggest it's stable.
But it's not always, right? It's seen as cyclical.
That's the common perception, and largely true. Highly cyclical. Demand for big-ticket capital goods, for shipping services, even some business services, it ramps up when the economy's booming and businesses are investing.
And tanks when things slow down.
Pretty much. Companies pull back on big investments, ship less stuff, maybe cut back on external services. So yeah, it acts like a barometer for the economy. Very sensitive.
Makes total sense. Buying $1 million machine is probably the first thing you delay if you're worried about next quarter.
Or you try to bring services back in-house. So even though it's essential, the revenue streams can swing quite a bit with confidence and investment levels.
Can you give us some specific company names, maybe some familiar ones, even if they mainly sell to other businesses?
Sure. In capital goods, you've got giants like GE Aerospace focused on engines. Now, Honeywell, very diversified industrial tech. Caterpillar, think big yellow construction gear, and Boeing in aerospace.
Right.
Then specialists like ABB, Emerson, Schneider Electric, Eaton in electrical equipment and automation, Otis for elevators, ASSA ABLOY for security doors, even 3M, Post-its, but they have huge industrial segments making tens of thousands of B2B products. And ITWLNO Toolworks, another diversified one.
Yeah, you don't see ads for most of those during the Super Bowl.
Exactly. Their customers aren't you and me directly. They sell B2B. Unlike, say, consumer staples, they don't usually build value on consumer brand awareness. It's all about performance, reliability, the tech helping other businesses.
Performance for their business clients is key.
Absolutely. How well does that jet engine perform? How efficient is that logistics software? That's what matters.
Okay, so diverse, foundational, B2B focused, and traditionally cyclical. Now, how do the analysts, the folks trying to figure out what these stocks are actually worth, how do they value them?
Right, that gets us into stock valuation models. Yeah. Analysts use these to estimate a company's intrinsic value, what it should be worth based on fundamentals, and usually derive a target price from that.
And we've got that interesting study you mentioned looking at what models analysts actually prefer across all the different sectors, not just theory, but practice.
Exactly. It looked at over 800 equity research reports covering all 25 main GICS industry groups. So it's a pretty solid look at what tools analysts reach for most often.
And the headline finding, what's the big picture?
The big picture is price earnings. The PE ratio is overwhelmingly dominant. It was the primary model flagged in 20 out of the 25 industry groups studied.
DE, probably the one most people know, price per dollar of earnings. Simple comparison.
It is. It's intuitive, makes comparing similar companies easy. But, and this is where it gets really insightful for us, the study highlighted some crucial exceptions to PE dominance. And one is directly relevant to the industrial sector.
Oh, okay. The exceptions tell the story.
They often do. Specifically in the capital goods industry group, while PE is used, the study found that price cash flow, or PCF, actually emerged as the primary model analysts rely on.
PCF, price to cash flow. Why cash flow over earnings specifically for the makers of big machines and equipment?
The source gives a really clear reason. Capital goods companies have massive capital expenditures, huge capex. They're constantly pouring money into building or upgrading factories, buying complex machinery themselves, funding heavy R&D.
Right, building a new semiconductor plant or developing a new aircraft engine costs billions.
Exactly, and cash flow is the absolute lifeblood for that. It funds the investments, maintains the assets, pays down the debt often taken on for these projects, and just keeps the lights on. Earnings are important, but cash flow shows the actual ability to generate the cash needed for these capital-intensive operations.
So PCF measures that cash generation ability relative to the stock price.
Precisely. For these companies, strong, consistent cash flow isn't just nice, it's essential for survival and growth. So analysts zero in on that.
Okay, so for businesses building big, expensive things, analysts look past reported earnings to the hard cash because that's what fuels the engine. Makes sense.
That's the key finding for capital goods. The study noted other preferences elsewhere, of course, like EV/EBITDA, enterprise valued earnings before interest, taxes, depreciation, amortization that was favored in energy, telecom, materials.
Why EV/EBITDA there?
Often used in capital-intensive sectors, or those with lots of debt or big non-cash charges like depreciation, it gives a cleaner look at operating performance before financing and accounting effects.
And price book, PB.
That pops up where assets are key, traditional manufacturing, real estate, and especially financials like banks and insurance. Measures value relative to assets on the books. But the study noted it's not common where intangible assets are the main value driver.
Right. And what about the classic discounted cash flow, DCF? You said it wasn't the preferred model anywhere.
Correct. It's used frequently in places like pharma, biotech, REITs, part of the toolkit. But it didn't emerge as the single preferred #1 model in any of the 25 groups.
That is surprising. Finance 101 teaches DCF as the gold standard for intrinsic value.
Well, there's theory and then there's practice. The study actually noted a trend, especially after the early 2000s, of analysts shifting away from complex multi-year models like DCF towards simpler single-period multiples like PE or EV/EBITDA.
Why the shift? Speed, comparability, market sentiment.
Probably a mix. Multiples are faster, easier for comparing peers quickly. They also tend to reflect current market mood and near-term expectations more directly. DCF, while robust, needs lots of assumptions about the distant future discount rates. It's complex, can give a wide range of values, and maybe feels less tied to the now.
So multiples are more practical for day-to-day buy-sell calls based on current conditions, while DCF is maybe more for that deeper, long-term intrinsic value assessment, less swayed by the market buzz.
But that seems to fit the findings. The idea that industry characteristics matter was supported. PE dominates, but less so where assets, REITs, energy, or capital structure, telecom, energy, are bigger factors, pushing analysts towards PB or EV/EBITDA.
You also mentioned something really interesting about how DCF is used, depending on the recommendation, buy, sell, or hold.
Yes, this was fascinating. The study found DCF is used significantly more often in sell recommendations than in buy or hold ones.
Okay, wait. Why use the intrinsic value model more when you think a stock is overvalued? Seems counterintuitive.
The logic they present makes sense, though. A sell rating means the analyst strongly believes the market price is too high compared to fundamental value. To make that case convincingly, they need a robust, objective yardstick.
Oh.
DCF provides that. It's based on projected future cash flows, discounted back. It's less likely to be puffed up by positive market sentiment that might be supporting high multiples and driving buy ratings.
So when an analyst needs to rigorously argue the market's wrong and a stock is fundamentally overpriced, they pull out the DCF to show the real value, stripped of hype.
Exactly. It helps build a solid, evidence-based case for that potentially contrarian sell call. It aligns with other research linking DCF to negative actions like downgrades.
What about companies heavy on intangible assets, like software, IP, brand value stuff not easily seen on the balance sheet? How are those valued?
The study looked at this, and the findings were a bit different from some other research. They tested if DCF was used more for companies with high reported intangible assets, things like patents or goodwill from acquisitions that are on the balance sheet.
When?
They rejected that hypothesis. Based on reported intangibles, DCF wasn't used more often.
So analysts aren't necessarily using DCF more just because a company has patents listed?
According to this study, no. Now, the source suggests a nuance. Maybe the difference is between reported versus unreported intangibles, things like internally developed software, customer lists, proprietary processes. Those are huge value drivers, but often don't show up clearly on the balance sheet. That might explain why other studies found different results.
Okay. So what did they find was used for companies with high reported intangibles?
Interestingly, PE was actually used more frequently in sectors with the highest reported intangibles, like household products or telecom services. Other multiples, sometimes suggested for intangibles like price sales, weren't commonly preferred here.
Wow. Okay. So valuation is complex, definitely industry specific. Capital goods analysts focus on cash flow, PCF. DCF is maybe less dominant day to day, but a key tool for justifying sell calls. And valuing intangibles still seems debated, with PE surprisingly common even for reported intangibles in this study. It really hammers home that you need to know how a company makes money to pick the right tool.
Absolutely. No one size fits all. The business specifics, capital needs, revenue type, growth path dictate the best metrics.
Now let's circle back to that cyclical nature. Industrials ride the economic waves, but are there bigger, maybe more permanent forces now that could be changing that dynamic, giving them more stability or growth outside the cycle?
That's probably the most critical question for the sector right now. Yes, it is still influenced by the macro cycle, inventory levels, business investment, interest rates.
Which we know hit capital-intensive firms hard.
Right. And transportation historically shows the most cyclicality freight volumes, consumer spending. Capital goods is sensitive to CapEx cuts and downturns. Commercial and professional services tends to be the least cyclical, with stickier recurring revenues.
But you're saying there are these powerful, long-term, secular trends that might be smoothing out some of that bumpiness, driving growth even if the broader economy hiccups.
Yes, exactly. Analysis from places like Guinness Global Investors really highlights this shift. These aren't just blips, they're multi-year transformations, creating major demand tailwinds.
Okay, what's the first big one?
Onshoring or reshoring. This has been building since, say, 2018 with trade tensions, U.S.-China specifically,
Right.
But then COVID hit.
And suddenly everyone realized how fragile those long supply chains were.
Totally. Lockdowns, shipping nightmares, geopolitical risk.
Yeah.
It forced a rethink. Companies are now actively trying to simplify, diversify where they make things, and crucially, bring production back home or closer to home, nearshoring too.
So building the next factory in North America instead of Asia, for example.
That's the idea. And it requires massive investment. New factories, updated infrastructure, local supply networks. It's expensive. Takes years, maybe 3 to 5 for a complex plant. But it creates sustained demand for construction, machinery, electrical gear, support services, everything in the industrial sector.
And companies are actually talking about this.
Oh, yeah. The source mentioned tracking mentions of reshoring or onshoring on earnings calls for Russell 3000 companies. It's way up. It's become part of the corporate thinking, the zeitgeist.
Okay, that's a direct demand driver. What's number 2?
Mega projects. This is about huge, large-scale industrial initiatives, often boosted by government incentives. We're talking projects costing over $1 billion each.
$1 billion per project. That's serious scale.
It is. The numbers are pretty staggering. Since early 2021, over $1.2 trillion in North American mega projects have been announced or committed. And get this, 52% of that announced spend is directly tied to U.S. federal incentives.
Half from government programs. Which ones?
Things like the Inflation Reduction Act, IRA, the Infrastructure Investment and Jobs Act, IIJA, the CHIP PS Act. They're pumping money into building domestic semiconductor plants, EV and battery factories, renewable energy projects, grid upgrades, better transportation infrastructure. It's a massive tailwind for industrials, creating demand not just tied to the business cycle.
Is this just a U.S. thing?
Mostly U.S.-driven at that scale, but Europe's doing similar things, maybe around $500 billion estimated in large projects, especially around energy transition.
So trillions flowing into next-gen industrial capacity.
Yes. And here's a key point from the analysis. As of when they looked, only about 15% of all that announced mega project spending since 2021 had actually turned into completed sales for industrial companies.
Meaning 85% is still coming. It's future demand.
Exactly. It's sitting in company backlogs, orders they have but haven't filled yet, or it's still in the planning pipeline. This suggests demand is locked in for years, likely the next 5 years or more, providing a really visible long-term growth path for companies involved.
Which leads right into the idea of backlog as a key thing to watch in this sector.
It does. Backlog, the value of orders received but not yet delivered, is super important for industrials, especially complex, long lead time stuff. It's your window into future revenue.
Like seeing the future sales already booked.
Pretty much.
Yeah.
And the source notes backlogs are generally elevated right now across the sector. That's partly strong demand for these trends, but also partly because supply chains are still tight and labor is scarce, making it hard to fulfill orders quickly.
So high backlog is good news for future sales, but maybe also a sign of production bottlenecks.
It's both. They expect backlogs might ease a bit as supply chains normalize, but the overall trend is growing backlogs. That's a strong positive signal. Companies mentioned with growing backlogs include big players like ABB, Eaton, Emerson, Schneider Electric.
Got it. And the final trend, reshaping things.
Mergers and acquisitions, M&A activity. With all these shifts, onshoring, mega projects, tech changes, companies are actively using M&A to reshape their businesses.
Buying into hot areas, selling off slower ones.
That's the play. Positioning for those secular trends. Now, M&A activity did slow down in 2023 and early 2024, mainly because higher interest rates made deals more expensive to finance.
Right. Connects back to the cost of capital we discussed.
Exactly. But the expectation is if rates start to ease, M&A will pick back up. Companies will likely keep targeting acquisitions in high-demand areas like data center infrastructure. Think AI, boom, energy infrastructure for the climate transition, and aerospace and defense, driven by geopolitics.
Okay, so these big trends, onshoring, mega projects backed by policy, visible backlogs, strategic M&A, they sound like a powerful force pushing against the old cyclical patterns, maybe creating more stable, multi-year growth, especially for certain subsectors.
That's the core argument. These feel like structural shifts, not just cyclical ups and downs. And you can kind of see it in subgroup performance. Analysis shows capital goods and commercial and professional services have generally outperformed transportation over the last 5 years. It links directly to the trends. Capital goods makers benefit hugely from investment in factories, infrastructure, defense. Commercial and professional services support all that activity. These segments have shown better margins, better returns on capital like ROA, CFROI, and stronger earnings growth. It suggests these secular drivers might be dampening their cyclicality more than for transportation, which is still very exposed to immediate freight volumes and fuel costs.
So the story is more nuanced now. It's not just economy up and industrials up. Specific parts, especially capital goods and services, are catching these longer-term waves.
That's the key insight. The focus tends to be on electrical equipment, machinery, and commercial services within those groups as being particularly well-positioned.
Now, all this activity needs physical space. Factories, warehouses, distribution hubs. Let's shift to the real estate side. What's happening in the industrial property market?
Yeah, this is vital. It's the physical foundation. We've got recent data from JLL looking at the U.S. industrial market in Q1 2025.
What did that show? Key takeaways.
Okay, first, leasing activity. It actually picked up in Q1, up 7.5% from the previous quarter to 123.3 million square feet. Still down year over year, but it was the best quarter since Q2 of last year. A bit of a rebound.
Were businesses looking for specific types of space?
Very clearly, yes. Mid-sized facilities, think 100,000 to 250,000 square feet were the sweet spot. They dominated Q1 leasing and, interestingly, have shown the most consistent demand over the last 5 years. Big contrast to the huge warehouses, over 750K square feet, which saw demand swing wildly with the pandemic e-commerce boom and bust.
Mid-size seems like the reliable workhorse then.
Looks like it. Also, new leases made up almost 70% of activity, so companies are actively taking new space, not just renewing. And there's a strong preference for Class A buildings, the top quality ones accounting for over 60% of leasing.
What makes a building Class A in the industrial world? Newer, taller?
Generally, yeah. Newer construction or heavily renovated. Higher clear heights for more storage, better loading docks, flatter floors for robotics, advanced sprinklers, more energy efficient, prime locations near transport and labor. Built for modern logistics and manufacturing, including automation.
Okay, so demand is for quality mid-size space. What about supply and demand balance? Vacancy versus absorption?
The national vacancy rate ticked up a bit in Q1 to 7.3%. That was mainly because a lot of new buildings finished construction without tenants already signed up.
So supply deliveries were still strong, some sitting empty initially.
Right. But the report expects vacancy might peak soon and then start to fall, as the market absorbs this space and fewer new projects break ground. On the other side, net absorption, the change in occupied space, actually improved significantly, up over 43% year over year in Q1 at 40 million square feet.
What drove that increase in space being filled?
A big factor was large build-to-suit projects moving in. These are custom-built facilities for one tenant. They accounted for a quarter of all absorption. The auto sector is huge here. Tesla took 2.3 million square feet in Houston. Toyota took 2 million square feet near Greensboro for their EV battery plant support.
Wow, those are massive single-tenant deals. Reflects big commitments. What about future supplies? A lot more construction coming.
Deliveries were steady in Q1. But the pipeline, the total space under construction, shrank quite a bit, down nearly 30% year over year, hitting the lowest level since 2015.
A 30% drop. That's significant. What's that signal?
Fewer new projects are starting, likely a reaction to rising vacancy and maybe tougher financing. Most of what's in the pipeline now, about 87%, is expected to finish in 2025. So supply growth should slow down quite a bit in 2026 and beyond.
Is any particular type of industrial building growing its share in that shrinking pipeline?
Yes, definitely. Manufacturing real estate. It's now 16% of the space under construction, up over 14% year over year. This directly reflects that onshoring trend we talked about. Companies are building new factories here.
So the need for modern production facilities is showing up in the construction data.
It is. And the report stresses how much modernization is needed. The average U.S. factory is over 50 years old, not built for today's tech. New leasing for manufacturing space was also up over 17% quarter over quarter in Q1. Demand is there.
Old factories need replacing. New ones are being leased. What about rents? They shot up for years. Are they cooling off?
Generally, asking rents are stabilizing. The national average dipped slightly in Q1, but was still up 0.5% year over year.
Stabilizing, but not falling overall yet. Why stabilizing?
In markets with higher vacancy, landlords are getting more competitive, offering concessions, maybe some free rent, money for tenant improvements to get deals done. Trade uncertainty might also make them more willing to negotiate. But the national average rent was actually held up by continued increases, specifically for manufacturing buildings in some key markets, showing that concentrated demand again.
And renewals. Are tenants staying put and paying more?
Yeah, renewals are strong. Businesses really want to avoid the hassle and cost of moving, so landlords often have leverage to push rates up when leases expire. Regionally, though, port markets, especially on the West Coast, are seeing rents decline. Only Houston and Tampa Bay saw slight growth among port cities.
Who are the main tenants leasing space in Q1?
A really big driver was Asian 3PLs, third-party logistics providers. They leased the most space. Why? Partly stockpiling inventory ahead of potential tariffs, partly regionalization, wanting distribution closer to North American customers.
So logistics firms adapting to trade winds by grabbing space stateside.
Exactly.
Yeah.
The Inland Empire in California saw a lot of these 3PLs taking those mid-sized spaces, 100, 200K square feet. And it's all underpinned by huge e-commerce growth, expected to hit $1.6 trillion by 2030, 20% of retail. E-commerce needs warehouses everywhere, facilitating that shift from just-in-case inventory far away to just-in-time closer to you, which 3PLs are great at managing with tech.
Sounds like the industrial property market, while maybe catching its breath on supply, has really strong underlying demand from e-commerce, supply chain shifts, and onshoring, especially for modern buildings. How do trade policies impact the real estate specifically?
Trade restrictions like tariffs mess with supply chains. That pushes companies to diversify where they produce stuff. But building a new factory, say, onshore, takes years, 3 to 5 years maybe. That creates uncertainty about exact long-term space needs, which might temporarily boost demand for flexible spaces, maybe shorter leases, while companies figure out their new footprint.
Adaptability needed on both sides then. What's the overall outlook for industrial real estate?
Short term, it's about smart location choices, affordability, access to transport, labor. Long term, demand looks strong from e-commerce and urbanization, needing goods closer to cities. One interesting thought, if 3PL costs keep rising, some big companies might bring logistics back in-house, changing the tenant mix.
And technology's role inside these buildings. Automation, AI.
Huge. AI and automation are changing everything inside the warehouse or factory. AI optimizing inventory, predicting machine maintenance, planning delivery routes. This creates demand for smart industrial spaces buildings with the power, connectivity, and layout to support these advanced systems.
So quality building isn't just about size and location anymore, it's about tech readiness.
Absolutely. The physical space has to evolve with the technology being used inside it. It impacts efficiency, requirements, ultimately profitability.
Okay, let's tie this all back to the big economic picture, especially interest rates. We touched on how they affect investment and M&A.
Right. The general relationship between interest rates, set by central banks like the Fed, and the stock market is typically inverse. Higher rates mean borrowing costs more.
For businesses buying machines, for consumers buying cars.
Exactly. Higher borrowing costs can mean less spending, slower business expansion, maybe lower corporate profits, which tends to pressure stock prices down. Financials can be an exception, sometimes benefiting. Conversely, lower rates make borrowing cheaper, potentially stimulating spending, investment, earnings, and supporting stock prices.
How does this hit a capital-heavy sector like industrials particularly hard?
Because they spend so much on capital goods, factories, equipment, infrastructure. Industrials are very sensitive to borrowing costs. Higher rates directly increase the cost of financing these essential investments and servicing debt. That can squeeze profitability and growth plans.
And we saw how higher rates cooled off M&A by making deal financing pricier.
Yep. Also, some parts of industrials act like growth stocks, valued on future potential.
Yeah.
Rising rates hurt growth stocks, generally, because future earnings are worth less when discounted back at a higher rate, and funding growth gets more expensive. Falling rates, on the other hand, can be a real boost. Cheaper to invest, expand, manage debt.
But you said the market reaction isn't always straightforward.
No, it's complex. The source we looked at, Investopedia, points out it depends on expectations versus reality, the size of the rate change, and the broader economic context. Are we worried more about inflation or recession? Sometimes the market reacts more to the signal the Fed is sending about the economy than the rate change itself. So it's a general rule, but context is key.
So understanding the rate environment and policy outline is another crucial layer for analyzing industrials, affecting everything from factory building costs to M&A feasibility.
Definitely. Cost of capital is fundamental, especially for sectors with big ongoing investment needs.
For someone listening who might be interested in getting exposure to this sector, how could they do it? You mentioned the XLI ETF earlier.
Yeah, the Industrial Select Sector SPDR Fund, ticker XLI, is probably the best-known ETF for broad exposure to U.S. industrials. It tracks the Industrial Select Sector Index, which pulls its companies from the S&P 500.
So it holds the big industrial names already in the S&P 500.
Correct. As of June 2025, it held 78 companies. It's known for having a pretty low expense ratio, around 0.08%, which is cost-effective. And it's large, managing over $21 billion in assets as of June.
Who are the biggest companies in it? The top holdings.
As of June 2025, the top 10 included names we've discussed: GE Aerospace, RTX, formerly Raytheon, Uber, Caterpillar, Boeing, Honeywell, Union Pacific Railroad, GE Vernova, the energy spinoff, ADP, payroll HR services, and Deere Farm and Construction Equipment.
That list really shows the diversity. We talked about jet engines, construction gear, ride-sharing, payroll.
It does. And if you look at the fund's industry breakdown, it's quite concentrated in certain areas. As of June 25, the biggest weights were aerospace and defense, around 25.6%, machinery, 18.1%, ground transportation, 10.7%, and electrical equipment, nearly 10%. So it reflects the market cap weight of the giants in those specific areas within the S&P 500.
So if you buy XLI, you're getting significant weight towards capital goods, A&D, machinery, electrical, and transportation. How has it performed?
Performance has generally tracked its benchmark index closely, maybe slightly lagging due to fees based on data up to March 2025. For the 5 years ending then, its NAV return was about 19.1% per year versus 19.3% for the index. Since it started back in late 98, it's returned about 9.3% annually on NAV, very close to the benchmark's 9.4%.
And the standard disclaimer, past performance is no guarantee of future results.
Always. It's just history. Future returns depend on what happens next.
So pulling everything together, what are the main pros and cons of investing in industrial stocks or a fund like XLI?
A source like DeGiro sums it up well. On the pros side, potential for long-term growth from global demand for infrastructure and goods, innovation automation, AI driving efficiency and performance, and diversification potential, both within the sector's different industries and relative to other sectors.
Makes sense. And the cons?
The big one is still volatility. Despite those secular trends, it is sensitive to economic cycles, global events like trade wars or pandemics. Competition is fierce, squeezing margins, and it's highly capital intensive. Constant need for investment in equipment, R&D, maintenance. That can weigh on cash flow and require smart financial management. Remember why PCF is key for capital goods. It's partly managing those huge capital needs.
Right, the upkeep costs are real. So if someone wants to analyze an individual industrial stock, what are the practical steps based on our discussion?
The Giro had a good checklist that ties into what we've covered. First, industry analysis. Go beyond the overall sector. Is it capital goods, services, transportation? How does that specific industry connect to trends like onshoring or mega projects? What are its specific prospects? Second, dig into the company financials. Revenue growth, margins, debt levels, and critically, cash flow generation. Apply those valuation concepts. Check PE versus peers. But for capital goods, really scrutinize PCF and their ability to fund CapEx and handle debt. Financial health first. Third, look at the management team. What's their track record, navigating cycles, executing big projects, adapting to change? Super important in this complex sector. Fourth, assess competitive position. What's unique about them? Market share. Are there high barriers to entry, like in aerospace? And finally, risk management. How exposed are they to downturns, rate changes, policy shifts, trade wars, tech disruption that need to invest heavily in AI? Understand the risks. And of course, diversification across companies, industries, and sectors is key to managing risk. Stay informed.
That's a really solid framework. It uses everything we've talked about: structure, valuation, trends, real estate, macro factors to approach analyzing these stocks practically.
Yeah, it's about getting past the simple cyclical label and digging into the specific drivers and challenges for each business within this vital, diverse sector.
Okay, quite the journey today. We went from defining this vast industrial sector, way more than just factories, to how analysts actually pick valuation tools. Then through those powerful secular trends like onshoring and mega projects reshaping its future, looked at the crucial real estate market, and finally how you might invest via something like XLI and what to look for.
I think the core takeaway is that while, yes, it's sensitive to cycles and rates, these huge multi-year structural forces are also profoundly shaping it, especially in capital goods and services. They're creating potentially more sustainable growth drivers, maybe changing that old cyclical profile. But you still absolutely need to understand the specific industry, the right valuation lens, and the macro context.
So the story isn't just about the economic waves anymore. It's the waves plus these potentially transformative undercurrents from global shifts in policy.
That's the dynamic picture emerging, yeah.
All right, here's something to chew on as you look around. With these massive government and corporate mega projects pushing reshoring and rebuilding, and with AI rapidly changing how factories and warehouses operate, could the industrial sector's reputation as just predictably cyclical be fundamentally changing for good? And how will this shift towards automated, smart industrial spaces change not just what buildings companies need, but maybe create a whole new competitive game based on tech adoption as much as manufacturing skill?
It's a fascinating time for a sector that's literally the engine of the modern world.
Thanks for walking us through it all.
My pleasure. Always interesting.